I want to buy a house this year, but I don't even know where or how to even begin. What should I do? This was a comment I read in one of my videos, and today will be all about helping you know what to do to buy a house correctly this year. So many people think that buying a house, it's a matter of going on to Zillow or realtor.com or whatever website you want to use to find those houses. And then you scroll through an endless list of properties. You take a look at a lot of pictures, then you save some of them under your favorite. And then once you gather all of the houses together, once you get that list, you will contact your realtor and check out all the houses where you place your beautiful little heart to. Oh, no. You're doing it all wrong. That is the last thing you should do. So for those who don't know, the process of buying a house takes approximately 2 years and it's divided into 3 different chunks. So first is the preparation, which takes up to, I'll say, 15 months. Then there is the house hunting part of things, and that usually take about 6 months, I would say. And then there's the financing part of things, and that takes about 3 months. So as you can see, this entire 2-year process will have the majority of the time focus on how to prepare. This is where you're going to spend most of your time trying to get ready to buy a house. And if you do this wrong, if you do this section of the preparation wrong, you could risk buying the wrong house or buying with the wrong mortgage, or maybe even a combination of both. And then you're going to get stuck with a house that you're not happy with, or a loan that you're not happy with, or worse, you can get stuck with both. So now let's go ahead and break down this entire preparation part. What is it that you need? Why should this take this long, right? Well, the first thing you need to keep in mind at the time of preparing, so to speak, to buy a house is that you need to take your taxes and your job into consideration. So the way it works is that when you're going to go and buy a house, typically what banks are going to ask you is 2 years worth of your income tax returns. They will probably ask you about your pay stubs and bank statements. In general, right? They ask for a bunch of other documents, but let's say at a high level, this is what they ask. And the thing with the taxes is that lenders will look at your taxes for 2 reasons. One, they want to make sure that you do, in fact, make the amount of money that you claim you're making. And so they want to verify that you do generate that income through your taxes. That's one. The second part of it is that they want to verify where you have been working, because typically through your taxes, they will see where you're making your money from. Where is it that you're gathering it? And of course, they also corroborate that with your pay stubs and also by checking your bank statements. They need to see that you are working for the same company. If for whatever reason you haven't been with a company long enough, then you might risk not getting financing for the purchase of your home. Why is that? Just think about this way. Let's say you just started a job and that you have been working in a company for 6 months. Chances are that if you've only been in your company for 6 months, that means that you're still kind of like in the trial process. You're still testing the waters, and the company that hired you is also testing the waters with you. They want to see whether you're capable of doing what you promised that you're going to deliver to them in that job offer, right? And so when banks look at something like that and they see that you have been in a job for less than 6 months, they are a little bit nervous about it. They see you as someone who's high risk because you could get fired within that time frame. Maybe you don't last enough, or maybe you don't even like your job enough to stay in the company a longer period of time. So therefore, switching jobs at the time that you plan to buy a property will actually work against you, and you can risk not getting financing at all. That's why this tax component here is very important, because they ask for 2 years to verify not just your income, but also to verify that you have been with the company a long time. Ideally, you should be working with the company for more than a year, and your opportunities kind of like open up. But the longer you stay at a company, the better it is for you when it comes to financing. So if you're kind of like in between jobs and you're switching, you might want to ask yourself, which one is more important? Changing careers right now for that new gig that's going to pay you more money and open better opportunities, but risking not getting the house? Or if you don't mind waiting a little bit longer until after you're close on your property purchase to switch jobs, then that's another option. But that's something for you to decide. You're going to have to figure out which one is more important in the event that you cannot get both, right? The job and the house. So you're going to have to pick and choose. Is the career more important and then you buy the house later? Or should you go for the house first and just remain in the same job? Maybe it wasn't that bad at the end of the day, right? So that decision will be entirely up to you. The second thing you need to keep in mind to better prepare to buy a house correctly is to get your debt under control, okay? Debt is certainly important. So there's this thing that the banks look at in you, something called the DTI, and that stands for debt to income ratio. And the DTI, in essence, what it does is that it is a ratio that compares your debt against your income. So if the DTI is high, then you're going to be seen as someone who is of high risk. Why? Well, you're high risk because you have too much debt. And when you have too much debt, chances are you might have trouble paying the mortgage, right? Because maybe you can afford it now, but all it takes is one little mistake for that debt to snowball, and then eventually you won't be able to afford either one of them. So they don't like people who have a high DTI. Lenders prefer customers that have a low DTI. So how do you calculate that DTI? It's very simple. It's your total debt divided by your total income. And lenders prefer to see anything that is 30% or under. Okay, the lower your DTI, the higher chances of getting better mortgage rates and better chances to qualify for better mortgages with better terms overall. And how does this whole debt component ties into the whole 15-month preparation thing? Well, let's look at some numbers. So let's say, for example, that you have a total currently of $20,000 in debt and you're making $60,000 a year, right? That's just a number that we're throwing out there. And when you do the math, that will give you 30%. Now, let's say you can stay at 30%, but you don't like those odds, so you want to improve that and you want to lower your DTI. So by lowering your DTI, you have to pay down your debt. And let's say you bring that debt down from $20,000 to $10,000. So you bring it down to $10,000, you're still making $60,000 a year, and that will put you at a DTI of 17%. And like I said, the lower the DTI, the better. But to get from $20,000 to $10,000, depending on how much money you're making or how much savings you have, getting from $20,000 to $10,000 could be a matter of 1 month, or could be a matter of multiple months for you to bring down that debt all the way down to $10,000. That's why you need time, you need preparation. So yeah, once again, the lower the DTI, the better it is for you. Bank likes people who have a low DTI because that means they have less debt. And with less debt, that means you have higher chances of making your mortgage payments on time and without any problems. And for you, it is better because you get to have better rates, better mortgage terms. Now, moving along, another thing you should take into account in this entire preparation thing in order to buy the house correctly is your credit. And I know a lot of us talk about credit here and credit over there, but there are certain things about credit that you really, really have to pay attention to. First, having a credit is not just a matter of a credit score. Lenders view your credit as a picture, meaning a movie of your relationship with debt. How are you managing debt and how are you managing money? Are you good at handling it and therefore it's reflected in your high FICO score? Or are you not doing a good job and therefore you have a low FICO score? So it's all about the relationship. And the longer you have that relationship and the more you get to show through your FICO score how you're interacting with debt and how responsible you are, the better it is for you. Then, of course, there's the credit component part. And if you have a FICO of 720 or above, you usually get much better terms. You get the opportunity to negotiate your mortgage rates. You can actually bring down your current mortgage rate in exchange of a fee. But if you have a FICO score lower than that, it might become a little bit difficult, but not impossible. It won't get your mortgage denied. However, you will have to pay higher interest rate. The higher the FICO score, the better the chances of getting a good mortgage rate and the higher the chances of negotiating your mortgage rates. Now, if you happen to be kind of like caught up in between paying debt, right? And you manage to pay down your credit card, but those payments are not reflected in your credit score as of yet, because for whatever reason, your credit card company did not report your payment on time, that's fine. You don't have to worry. You can actually request your lender or your mortgage broker, depending on whom you are working with. You can actually request them to reach out to the credit bureaus and ask them to do a rapid rescore, which is in essence the credit bureaus updating your credit profile immediately, and the changes are going to be reflected immediately in your FICO score, and hopefully you will get that newer, higher score. This is something that I've done a couple of times and it has done wonders, but only your lender or your mortgage broker can request that, as far as I know. This is not something that you can request personally, but if you have been able to do that, please share your experience down in the comment section so that way we can learn about your experience and, how you did it. The next thing you need to take into account to buy a house correctly is the down payment. You see, many people think that in order to buy a house, you will need a down payment of 20%. But that's not entirely true. You can actually buy a house with as little as 5% down. But being able to access those good mortgages will require you to take care of the first 3 steps that I talked about: your credit, your taxes, your job, and your DTI. Having the opportunity to pay a 5%, it's a great way to be able to enter the housing market without having to put that much money up front. So let's assume, at today's prices, you are buying a house of $450,000. 5% down payment on that is the equivalent of $22,500, as opposed to a 20%, which is $90,000. So it is much easier to gather $22,500 than to gather $90,000. For those who want to learn more about this whole 5% mortgage plan, here's a video that I created a couple of weeks ago that you can check out after you're done with this one. So those are the things you need to consider in terms of strategy, right? And things that you need to do to strategize, to plan, bring down the debt, bring up your credit score, and all of that. Then there is another step, another thing you need to do that doesn't necessarily have to do with strategy, but it has a lot to do with you, your control of your emotions and your control of your mental energy. Meaning, are you humble enough to accept what's coming for you? I'm not talking about buying a house is a big responsibility and yada and all that stuff. No, I'm not talking about that. I'm talking about, are you humble enough to accept the right house for you? Because let's face it, sometimes a lot of us allow emotions to get the most out of us, right? You think about, that dream house you want to buy, and then you want the pool, you want the fancy kitchen, the fancy bathroom, the nice parking space, you would like to have a rooftop and a deck and all of that stuff. That's great. And I'm sure you deserve that dream house. But is that the best house for you right now, today? Let's face it, 90% of us might not necessarily get our dream house, but we can get our house. It's a good starting point. What truly matters is, can you live comfortably in that house? Is that house located in a good area where you and your family feel safe? And can you even afford to make upgrades to that house? Because the last thing you want to do is to get stuck in a house that is consuming your entire paycheck. It doesn't allow you to do anything else. You're actually a slave to the house. And buying the right house for you is not necessarily so bad. Because if you buy the right house that you can afford right now, that means that financially, you're going to be more comfortable. You're going to have an additional money to save up for an emergency fund, or why not even to save up for additional work that you might be doing on the house, which eventually is going to help the house go up in value. And eventually in the future, you can either do a cash out refi, or you can sell the house and use that money and maybe buy a much bigger house, or possibly buy your new dream house. It's all about having the right strategy and being patient. I have not yet met any successful investor who doesn't do both of those combined. Having a good plan and having a lot of patience. Buying the right house for you, the house that you can afford, is not necessarily a bad thing. Yes, you do deserve your dream how, but can you wait? Sometimes the wait made things better. Now, for those working on your credit and to improve it and you want to take it to the next level, we have a credit course called A Credit Millionaire. And with that course, you can actually improve your credit and handle your credit as if you are a millionaire. You're going to get top notch, and a lot of opportunities are going to open up for you once you learn how to manage your credit like the millionaire's way do. For those interested, the link to the course is down in the description box below and also down in the comment section. See you in the course. Bye-bye.